On October 22, 2024, at the BRICS summit in Kazan, Russia, Vladimir Putin held up a mock banknote. It wasn't the ruble. It wasn't the yuan. It was a prototype BRICS currency, featuring the flags of all member nations, denominated in a new unit that doesn't yet exist. The symbolism was clear. We're building an alternative to the dollar. Financial media went wild. Headlines screamed, BRICS to launch dollar killer currency. De-dollarization accelerates. The end of U.S. financial dominance. Gold bugs and crypto maximalists celebrated. Dollar skeptics said, I told you so. CNBC brought on experts who gave it a 50-50 chance of working. But here's what nobody mentioned. This is the 12th attempt in 50 years to create a dollar alternative. 12. And the previous 11? They either failed completely, achieved limited regional success, or became exactly what they were trying to replace, another tool of geopolitical power. Let me give you the list. 1. 1960 S70S, SDR, special drawing rights, created by IMF to replace dollar. Failed. Currently 3% of reserves. 2. 1999 Euro partial success in Europe. Never challenged dollar globally. Now 20% of reserves, down from 28% peak. 3. 2001 Japanese yen internationalization total failure. Yen is 5% of reserves. 4. 2009 China's yuan internationalization 15 years later, 2.7% of reserves. 5. 2010 Gulf Cooperation Council currency Saudi Arabia, UAE, Kuwait were supposed to launch a common currency. Never happened. 6. 2014 Eurasian Economic Union currency Russia, Kazakhstan, Belarus. Announced, never launched. 7. 2015 ASEAN Currency Unit Southeast Asian Common Currency. Still under study. 8. 2018 petroyuan China settling oil trades in yuan. Limited success, minus 15% of oil trades, mostly with sanctioned countries. 9. 2019 Libra/DM Facebook's attempt at a global digital currency. Regulated to death, shut down 2022. 10. 2020 Digital Euro ECB's CBDC. Still in pilot phase, no launch date. 11. 2022 Commodity-backed BRICS currency. Announced after Ukraine war. Nothing materialized. And now, 2024 to 2025, BRICS currency attempt number 12. Everyone thinks this is new. This is revolutionary. This time it's different. I'm going to show you why it's not different. Why the same structural problems that killed the previous 11 attempts are still present. Why BRICS has only 2 of the 4 critical requirements for success, and why those 2 might not be enough. But I'm also going to show you the 30% probability scenario where it does work, partially. And what that means for your portfolio. Because this isn't about predicting the future with certainty. It's about understanding the probabilities and positioning accordingly. 3 scenarios. 1. Complete failure, 50% probability BRICS currency never launches or dies within 2 years. 2. Partial success, 30% probability regional trade currency, limited global impact, dollar remains dominant. 3. Revolution, 20% probability multipolar monetary system, dollar share falls below 40%, chaos for 5 to 10 years. By the end of this video, you'll know which scenario is unfolding, how to track it, and how to hedge each one. Let's start with history. Because those who don't learn from the previous 11 failures are condemned to lose money on the 12th. Attempt 1 SDR, Special Drawing Rights, 1969. The plan. After Bretton Woods was straining, the IMF created SDRs, a basket currency combining dollar, pound, franc, Deutschmark, and yen. The idea was to replace the dollar as the primary reserve asset. Countries would hold SDRs instead of dollars. Global trade would be denominated in SDRs. The dollar would become just one currency among many. What happened? SDRs never caught on. Today, 55 years later, they represent 2.9% of global reserves, $943 billion out of $12 trillion total. Why it failed? No market. You can't use SDRs to buy oil, pay workers, or settle trade. They only exist for central bank accounting. IMF control. The IMF is dominated by the US and Europe, voting shares, US 16.5%, EU combined 30%. So SDRs just became another dollar proxy. No enforcement mechanism. Countries couldn't be forced to accept SDRs for trade. Lesson: a reserve currency needs actual usage, not just accounting fiction. Attempt 2, Euro 1999. The plan. European Union creates a single currency. 19 countries, now 20, abandon their national currencies. The euro becomes a genuine alternative to the dollar, backed by the world's second largest economic bloc. What happened? Partial success. The euro became the world's second reserve currency. 1999, 18% of global reserves. 2009, peak at 28%. 2024, 20%, declining. But it never challenged dollar dominance, 58% of reserves. And it created massive internal problems: Greece, Italy, Spain debt crises, no fiscal union, political fragmentation. Why it didn't fully succeed? No unified fiscal policy. Germany and Greece use the same currency but have completely different economies. This creates unsolvable tensions. No European military/geopolitical power projection. The US can enforce dollar usage through military and diplomatic pressure. Europe can't. Bond market fragmentation. There's no single Eurobond, like US Treasuries. You have German bonds, Italian BTPs, Greek bonds, all different risk profiles. This limits liquidity. Political fragmentation. 20 countries, 20 governments, constant disagreements. The US has one policy. Europe has 20. Lesson: a common currency needs political unity and geopolitical power. Europe has either. Attempt 3 to 4, Yen and Yuan internationalization 2001 and 2009. The plan: Japan. In the 2000s, Japan was the world's second largest economy. They tried to make the yen a reserve currency. Encouraged yen-denominated trade, yen bonds, yen reserves. What happened? Total failure. The yen is 5.3% of global reserves. Nobody uses it outside Japan. Even Asian countries prefer dollars. Why it failed? Capital controls. Japan maintained some controls on capital flows, limiting yen liquidity globally. Limited geopolitical influence. Japan is a US ally, militarily dependent on the US. They can't offer an independent alternative. Demographic collapse. Japan's population has been shrinking since 2008. Hard to be a reserve currency when your economy is stagnant. The plan: China. Starting in 2009, after the financial crisis, China aggressively promoted yuan internationalization. Established currency swap lines with 40-plus countries. Created yuan clearing banks globally. Launched Belt and Road Initiative with yuan-denominated lending. Settled oil trades in yuan, petroyuan. Pushed for yuan inclusion in IMF's SDR basket, achieved in 2016. What happened? After 15 years of effort, the yuan is 2.7% of global reserves. Yes, you read that right. 2.7%. For comparison, the Australian dollar is 1.9%. The Canadian dollar is 2.4%. China, the world's second largest economy, has a reserve currency share barely above Canada. Why it failed, so far? Capital controls. You can't freely move yuan in and out of China. The government controls the exchange rate. No free convertibility equals no trust. Rule of law concerns. Foreign investors feared the Chinese government could freeze assets, change rules, or seize holdings at any time. See Jack Ma and Group, Evergrande. Liquidity. Yuan bond markets are tiny compared to treasuries. There's nowhere to park $1 trillion in yuan safely. Opposition from the US. The US has actively worked to prevent yuan adoption, using its control of SWIFT and international banking. Lesson: you can't have capital controls and a reserve currency. You need free capital flows and rule of law. China has neither. Attempts 5 to 8, Regional Currency Unions, various, 2010 to 2020. Gulf Cooperation Council Currency. 6 Arab Gulf states, Saudi Arabia, UAE, Kuwait, Qatar, Bahrain, Oman, planned a common currency like the euro. Target launch, 2010. Status, never launched. Each country kept its own currency. Eurasian Economic Union currency. Russia, Kazakhstan, Belarus, Armenia, Kyrgyzstan planned a common currency. Announced 2014. Status, never launched. Each kept its own currency. ASEAN Monetary Unit. Southeast Asian nations planned a common trade currency. Under discussion since 2006. Status, still, under study, 19 years later. East African Community Shilling. Kenya, Uganda, Tanzania, Rwanda, Burundi, South Sudan planned a common currency. Target, 2012, then 2015, then 2024. Status, still hasn't launched. Why all of these failed? Trust deficit. Countries don't trust each other enough to give up monetary sovereignty. Economic divergence. You can't have a common currency when one country has 10% inflation and another has 2%. Political will. It's hard. It requires sacrifice. Politicians prefer easy solutions. No enforcement. If a country cheats, runs deficits, prints money, who enforces discipline? Lesson: regional currency unions only work with deep political integration, which is why even the euro struggles. Attempts 9 to 11, digital currencies, 2018 to 2024. Petroyuan, 2018. China launched yuan-denominated oil futures contracts. Goal: settle oil trades in yuan instead of dollars. Status: partial success. Minus 15% of global oil trade now settles in yuan, mostly Russia, Iran, Venezuela, sanctioned countries. But 70% still in dollars. Libra/DM, 2019 to 2022. Facebook tried to create a global stablecoin backed by a basket of currencies. 2.9 billion users could have adopted it instantly. Status: regulated into the ground by the US and EU. Shut down in 2022. Why it failed: governments won't allow private companies to create currency. It threatens monetary sovereignty. Digital Euro, 2020 present. ECB is developing a central bank digital currency, CBDC. Supposed to compete with dollar for digital payments. Status: still in pilot phase. No launch date. Already facing privacy concerns and political resistance. Lesson: even digital currencies face the same problems: trust, liquidity, geopolitical power, and political will. The pattern: 11 attempts, 0 full successes. Let's summarize. SDR, 1969. Status: failed. Today it's about 2.9% of global reserves. Euro, launched in 1999. Status: partial success. Around 20% of global reserves. Japanese yen, early 2000s push, around 2001. Status: failed as a true dollar alternative. Today it's about 5.3% of reserves. Chinese yuan, internationalization started around 2009. Status: limited success. Roughly 2.7% of global reserves. Gulf Cooperation Council Common Currency. Plan for 2010. Status: never launched. Share of reserves 0. Eurasian Economic Union currency. Announced in 2014. Status: never launched. Share of reserves 0. ASEAN Common Unit. Discussed since around 2015. Status: still, under study. Real share and reserves 0. Petroyuan, 2018. Status: limited success. Roughly 15% of global oil trade, but nowhere near dominance. Libra, later DM, Facebook's 2019 project. Status: dead. Shut down. Share of reserves: 0. Digital Euro, project started in 2020. Status: not launched yet. Share of reserves: 0. BRICS, commodity-backed currency, proposal from 2022. Status: nothing materialized. Share of reserves: 0. Total impact on dollar dominance. The dollar's share of reserves has fallen from 70%, 2000, to 58%, 2024. A 12 percentage point drop over 24 years. At this rate, the dollar will still be 50% plus of reserves in 2050. This is why I'm skeptical of BRICS currency attempt number 12. But let's analyze it properly. Because unlike the previous attempts, BRICS has some things going for it. Based on 50 years of history, a reserve currency alternative needs 4 things to succeed. Requirement 1: economic size. Definition: the currency zone must represent a large enough share of global GDP to matter. Why it matters? If your currency only represents 5% of global GDP, nobody will bother using it for trade. There's not enough economic activity to justify the switching costs. Historical data. Dollar zone, US plus countries pegged to $25% of global GDP. Eurozone, 15% of global GDP. Yuan zone, 18% of global GDP, China alone. BRICS status. BRICS countries: Brazil, Russia, India, China, South Africa plus 2024 additions, Egypt, Ethiopia, Iran, UAE. Combined GDP: $28.5 trillion, PPP terms. Share of global GDP: 36%. Share of global population: 45%. White heavy checkmark. BRICS passes requirement 1. This is actually impressive. BRICS represents more economic activity than the US and EU combined, in PPP terms. If they can unite this economic bloc behind a common currency, the size is sufficient. Requirement 2: deep, liquid capital markets. Definition: there must be a large, liquid bond market where investors can safely park trillions of dollars. Why it matters? The dollar is dominant because of US Treasuries, a $27 trillion market where you can buy or sell billions of dollars worth instantly, safely, with minimal price impact. Any dollar alternative needs an equivalent bond market. Historical data. US Treasury market, $27 trillion, $640 billion daily trading volume. Eurozone bond market, $15 trillion, fragmented across 20 countries, $200 billion daily volume. Chinese bond market, $22 trillion, but foreign ownership is only 3%, $660 billion. BRICS status. Combined bond markets. China, $22 trillion, but only 3% foreign ownership. India, $2 trillion. Brazil, $1.5 trillion. Russia, $0.3 trillion, mostly frozen/sanctioned. Others, $1 trillion combined. Total, $26.8 trillion. But here's the problem: these markets are fragmented, illiquid for foreigners, and subject to capital controls. China's $22 trillion market is meaningless if foreigners can't freely buy, sell, and repatriate. And they can't. Cross-mark BRICS fails requirement 2. There's no unified BRICS bond market. There's no BRICS treasury, where you can park $1 billion safely and get it out tomorrow. Until this exists, nobody will hold large reserves in a BRICS currency. Requirement 3. Rule of law and property rights. Definition: investors must trust that their assets won't be seized, frozen, or devalued arbitrarily by the government. Why it matters? The dollar is trusted because the US has, mostly, respected property rights for 200 plus years. Courts are, relatively, independent. Contracts are enforced. Yes, the US froze Russian reserves in 2022, but that was an extreme exception after an invasion. For normal countries, dollar assets are safe. Historical data. World Bank Rule of Law Index 0-100 scale. United States, 91. Eurozone average, 88. Japan, 93. BRICS scores: Brazil, 49. Russia, 38. India, 56. China, 49. South Africa, 63. UAE, 68. Iran, 24. Egypt, 38. Ethiopia, 32. Average BRICS score, 46. Cross-mark BRICS fails requirement 3. Half of BRICS countries are rated below 50 on rule of law. China and Russia, the two largest economies, are outright authoritarian states where the government can seize assets at will. Why would anyone hold reserves in a currency controlled by governments with this track record? This is the killer. Even if BRICS builds a massive bond market, nobody will use it unless they trust the legal system. And nobody trusts China or Russia's legal systems. Requirement 4. Geopolitical power and network effects. Definition: the ability to encourage/force other countries to use your currency. Why it matters: the US doesn't just have economic power. It has military, 750 bases in 80 countries, 11 aircraft carriers, ability to project power globally. Swift control: the US can cut countries off from international payments. IMF/World Bank control: US effectively controls these institutions. Alliance network: NATO, Five Eyes, treaties with 50-plus countries. This creates network effects. Everyone uses dollars because everyone else uses dollars. It's self-reinforcing. BRICS status. Why heavy checkmark BRICS passes requirement 4, partially. BRICS has collective military power. China and Russia are nuclear powers. India has significant military. Combined, they rival US military spending. Alternative payment systems. China's CIPS, cross-border interbank payment system, already processes $13 trillion annually. Russia's SBFS system. India's UPI. Geopolitical independence. BRICS countries aren't US allies. They have their own geopolitical interests. Resource control: Russia, energy; Brazil, agriculture; South Africa, minerals; China, manufacturing. Combined, they control huge chunks of global supply chains. This is actually BRICS' strongest advantage. They don't need US permission to trade with each other. They can create their own payment systems. They have geopolitical independence. But they lack unified command. NATO has one leader, US. BRICS has 9 countries with conflicting interests. No enforcement mechanism. If Brazil stops accepting the BRICS currency, who forces them? Internal rivalries. India and China are literally in border disputes. Russia and China have historic tensions. These aren't natural allies. So it's a qualified pass. They have the power, but not the unity. The scorecard. Requirement 1, economic size. Status: pass. BRICS together make up roughly 36% of global GDP. Requirement 2, capital markets. Status: fail. Their markets are fragmented, relatively illiquid, and constrained by capital controls. Requirement 3, rule of law. Status: fail. On average, BRICS countries score around 46 out of 100 on rule of law indices. Requirement 4, geopolitical power. Status: partial. The bloc has real power and resources, but lacks the political unity to use them as one. BRICS has 2 out of 4 requirements, 1.5 if you count the partial pass. Historical precedent. Dollar, 4/4 white heavy checkmark. Euro, 3/4, fails geopolitical power, partial success. Yuan, 2/4, has size and geopolitical power, lacks capital markets and rule of law, limited success, 2.7% reserves. Yen, 1.5/4 failed. SDR, 0/4 failed. Prediction based on history. With 2/4 requirements, BRICS currency will likely achieve limited regional success similar to the yuan, useful for BRICS internal trade, but won't challenge dollar globally. But let's model 3 scenarios properly. Scenario 1, complete failure, 50% probability. What happens? 2025. BRICS Summit announces detailed plans for currency. Initial enthusiasm. Technical working groups formed. Studies commissioned. Media hype. Dollar killer is coming! 2026. Internal disagreements emerge. India wants different structure than China. Brazil has second thoughts. Russia wants it gold-backed. China wants digital yuan integration. Implementation deadlines slip. Launch by 2027 becomes launch by 2028. A pilot program launches for bilateral trade between Brazil and China. Volume: $5 billion per year. Insignificant. 2027 to 2028. Pilot program fails to expand. Technical issues. Banks don't want to deal with complexity. Traders prefer dollars. They're liquid and familiar. One or two countries, likely Brazil or South Africa, quietly exit the project. The BRICS currency becomes a symbolic gesture used for 1 to 2% of intra-BRICS trade. 2030. Project is quietly shelved or exists in name only. Dollar remains 55 to 58% of reserves. BRICS currency is remembered like the Gulf Cooperation Council currency, a nice idea that never materialized. Why this is the most likely scenario? Historical precedent: 9 of 11 previous attempts failed completely. BRICS lacks two critical requirements: capital markets, rule of law. Internal divisions: India-China tensions, Brazil's Western ties, South Africa's instability. No forcing mechanism: countries can't be forced to use it. Path of least resistance: using dollars is easier. Switching costs are high. Indicators this scenario is unfolding. 1. Launch dates keep slipping. If launch by 2026 becomes launch by 2027 becomes launch by 2028, it's failing. 2. Pilot programs stay tiny. If intra-BRICS trade in the new currency is 5% of total by 2027, it's not working. 3. Countries exit. If Brazil, India, or South Africa publicly or quietly abandons the project. 4. Dollar reserve share stable. If dollar stays above 55% of global reserves through 2027. 5. No major oil producers accept it. If Saudi Arabia, UAE, despite being BRICS members, and other Gulf states don't accept BRICS currency for oil. Portfolio strategy for Scenario 1. If this unfolds, the dollar remains dominant. Your portfolio should reflect continued dollar hegemony. 60% U.S. equities, 20% U.S. treasuries, 10% international developed markets Europe, Japan, 5% gold basic hedge, 5% emerging markets. Standard portfolio. No dramatic changes needed. Scenario 2, partial success, 30% probability. What happens? 2025. BRICS announces concrete currency structure, basket-backed, 40% yuan, 20% rupee, 20% ruble, 10% real, 10% rand, or commodity-backed, gold, oil. Digital infrastructure built on China's CIPS system plus blockchain for transparency. Initial trade volume, $50 billion per year. 2026. Successful expansion. Russia sells oil to China and India in BRICS currency. China settles manufacturing exports to Brazil in BRICS currency. Volume reaches $200 billion per year, still only 2% of BRICS total trade. But growing. Saudi Arabia and UAE begin accepting partial payment in BRICS currency, 10 to 15% of oil sales. 2027. Other countries join as observers: Indonesia, Malaysia, Thailand, Mexico, Argentina. BRICS currency volume hits $500 billion per year. Dollar's share of reserves begins declining, 58%, 54%. 2028 to 2030. A two-tier system emerges. O Tier 1, West US, Europe, Japan, allies still use dollars. O Tier 2, East/Global South BRICS, aligned countries, use BRICS currency for 30 to 40% of trade. Dollar remains dominant globally but no longer hegemonic. Dollar's share of reserves, 50%, down from 58%. BRICS currency, 8 to 10% of reserves. Euro, 20%, yuan, 5%, BRICS, 8%, others, 17%. Why this scenario is plausible? BRICS has economic size and geopolitical power. That's 2/4 requirements, enough for regional success. Sanctions on Russia created urgency. Countries fear being cut off from dollars, so they want alternatives. Digital infrastructure makes it feasible. China's CIPS already works. Adding other currencies is technically possible. Commodity backing: if BRICS backs the currency with gold, oil, and commodities, it solves the trust problem partially. You're not trusting China, you're trusting the gold. Indicators this scenario is unfolding. 1. Launch happens on schedule. Currency actually launches by end of 2026. 2. Rapid volume growth. Intra-BRICS trade in new currency reaches $200 billion plus by 2027. 3. Major commodity trades. Russia, Iran, Venezuela, Saudi Arabia accept BRICS currency for oil by 2027. 4. Observer countries join. 5 plus additional countries join as observers or users by 2028. 5. Dollar reserve share falls below 55%, clear signal of diversification. 6. BRICS bond market emerges, a unified $2 to $3 trillion bond market where investors can park funds. Portfolio strategy for Scenario 2. If this unfolds, you need to hedge dollar depreciation. 40% U.S. equities, reduced from 60%. 10% U.S. Treasuries, reduced from 20%. 15% emerging market equities, BRICS countries, India, Brazil, China. 15% commodities, gold, oil, agriculture, things BRICS controls. 10% gold, doubled from 5%. 5% Bitcoin, benefits from dollar depreciation. 5% cash in multiple currencies, Euro, CHF, SGD, diversification. You're hedging but not abandoning the dollar. It's still 50% of the system, just no longer 70%. Scenario 3, revolution, 20% probability. What happens? 2025. BRICS announces fully commodity-backed digital currency. Backed by gold, 30%, oil, 30%, basket of 10 commodities, 40%. Saudi Arabia shocks the world by joining BRICS and accepting 50% of oil payments in BRICS currency immediately. Other major oil producers, UAE, Iraq, Iran, Venezuela, Angola, follow. 2026. Petroyuan becomes Petro-BRICS. 40 to 50% of global oil trade now settles outside dollars within 18 months. Dollar crashes. DXY falls from 105 to 85, 19% devaluation. U.S. Treasuries sell off. Foreign holders dump $2 trillion. Yields spike to 6 to 7%. Fed forced to print money to buy treasuries. Inflation returns, 6 to 8%. 2027. More countries join BRICS currency system. Indonesia, Mexico, Argentina, Turkey, Nigeria, Pakistan, 40-plus countries representing 60% of global population. Dollar's share of reserves collapses, 58%, 42%. BRICS currency, 20% of reserves, faster than any currency in history. The global financial system bifurcates. O Western Bloc, US, Canada, EU, UK, Japan, Australia, 30% of global GDP. O Eastern Bloc, BRICS Plus, 45% of global GDP. O Swing States, undecided, 25% of global GDP. 2028 to 2030. The US faces a balance of payments crisis. Can no longer run $1 trillion trade deficits because foreigners aren't buying treasuries. Forced austerity or high inflation, or both, stagflation. Dollar stabilizes at new equilibrium, 40% of reserves, down from 58%. Global system now truly multipolar, dollar 40%, BRICS 20%, Euro 20%, Yuan 10%, others 10%. Why this scenario is unlikely but possible. Low probability, 20%, because it requires near-perfect execution by BRICS, major strategic blunders by the US, and rapid coordination among 40-plus countries. History shows this is very hard. But not impossible because the US froze Russian reserves, proving dollar weaponization is real. China has the infrastructure, CIPS, and will, de-dollarization. Commodity backing solves trust issues. If Saudi Arabia flips, big if, petrodollar system collapses overnight. Indicators this scenario is unfolding. 1. Saudi Arabia accepts 50% plus oil payments in BRICS currency by 2026. This is the domino. If this happens, everything else follows. 2. DXY falls below 90 rapidly, within 12 months market panic, dollar flight. 3. 10-year Treasury yields above 6%, loss of confidence in U.S. debt. 4. BRICS membership explodes, 20-plus new members by 2027. 5. Dollar reserve share falls below 50% by 2028, unprecedented speed of decline. 6. Capital controls in the U.S. If the U.S. implements restrictions on moving money out of dollars, it's an admission of crisis. Portfolio strategy for Scenario 3. This is the dollar collapse scenario. Maximum defensive positioning. 20% U.S. equities, minimal exposure. 0% U.S. treasuries will be destroyed. 25% international equities, emerging markets, commodity producers. 20% gold, maximum safe haven. 15% commodities, oil, agriculture, metals. 10% Bitcoin/crypto, alternative to failed fiat. 10% cash in multiple currencies, CHF, SGD, and OK, BRICS currency if available. This is a bunker portfolio. You're assuming the dollar system fails and positioning for the multipolar world. Here's your actionable playbook. Based on which scenario unfolds, here's exactly how to allocate across 15 major asset classes. U.S. large cap stocks, 50% in Scenario 1, 30% in Scenario 2, 15% in Scenario 3. U.S. small cap stocks, 10% in Scenario 1, 10% in Scenario 2, 5% in Scenario 3. U.S. Treasuries, 20% in Scenario 1, 10% in Scenario 2, and 0 in Scenario 3. International developed markets, Europe and Japan, 10% in all three scenarios. Emerging markets, mainly BRICS, 5% in Scenario 1, 15% in Scenario 2, 25% in Scenario 3. Gold, 5% in Scenario 1, 10% in Scenario 2, 20% in Scenario 3. Silver, 0 in Scenario 1, 3% in Scenario 2, 5% in Scenario 3. Oil and energy stocks, 5% in Scenario 1, 8% in Scenario 2, 10% in Scenario 3. Agriculture and farmland, 2% in Scenario 1, 5% in Scenario 2, 8% in Scenario 3. Base metals and mining, 2% in Scenario 1, 4% in Scenario 2, 7% in Scenario 3. Bitcoin, 0 in Scenario 1, 5% in Scenario 2, 10% in Scenario 3. U.S. real estate, 10% in Scenario 1, 5% in Scenario 2, 3% in Scenario 3. International real estate, 3% in Scenario 1, 5% in Scenario 2, 7% in Scenario 3. Cash in U.S. dollars, 8% in Scenario 1, 3% in Scenario 2, 0 in Scenario 3. Cash in multiple currencies, 0 in Scenario 1, 5% in Scenario 2, 10% in Scenario 3. How to use this matrix. 1. Start with Scenario 1 allocation. Current base case. This assumes BRICS fails like most previous attempts. 2. Monitor the indicators quarterly. Track the 5 to 6 key indicators for each scenario. 3. Shift allocation as indicators shift. If 3 plus Scenario 2 indicators trigger, move to Scenario 2 allocation. If 3 plus Scenario 3 indicators trigger, move to Scenario 3 allocation. 4. Don't go all in on any scenario. Even if you think Scenario 3 is happening, keep 15 to 20% in US assets. Diversification protects against being wrong. Transition rules. Scenario 1 Scenario 2 happens gradually. Shift 5 to 10% per quarter over 2 to 3 quarters. Scenario 2 Scenario 3 could happen rapidly, Saudi flip. Be ready to shift 30% of portfolio in 1 to 2 weeks if needed. Any scenario back to Scenario 1. If BRICS fails after initial success, reverse the shifts. Conclusion: the 12th attempt. BRICS Currency 2025 is attempt number 12 to create a dollar alternative. History: 11 previous attempts. 9 complete failures. 1 partial success Euro. 1 limited success Yuan. BRICS Scorecard. Wide heavy checkmark economic size, 36% of global GDP. Cross-mark capital markets, fragmented, illiquid. Cross-mark rule of law, average score 46 out of 100. Warning: geopolitical power exists but lacks unity. Grade 2 out of 4 C-. 3 scenarios. 1. Complete failure, 50% never launches or dies quickly. Dollar remains 55% plus of reserves. 2. Partial success, 30% regional trade currency, 8 to 10% of reserves, dollar falls to 50%. 3. Revolution, 20% multipolar system, dollar falls to 40%, chaos for 5 to 10 years. What you should do: 1. Accept uncertainty. Nobody knows which scenario will unfold. Anyone claiming certainty is lying or selling something. 2. Start with base case. Scenario 1 probability favors failure based on history. Allocate accordingly. 3. Monitor indicators quarterly. O launch dates and volumes. O Saudi Arabia oil payment methods. O DXY levels. O dollar reserve share. O BRICS membership growth. 4. Be ready to shift. If indicators move towards scenario 2 or 3, shift allocation accordingly. Use the matrix. 5. Don't panic, don't ignore. This is a 5 to 10 year trend. You have time to adjust. But ignoring it because BRICS will fail is also a mistake. My personal assessment. Base case, Scenario 1, 60% probability after deeper analysis. BRICS will announce big plans, struggle with implementation, and achieve limited usage. But I'm watching for Scenario 2 indicators. If we see $200 billion plus volume by 2027 and Saudi acceptance, I'll shift my portfolio. Scenario 3 remains tail risk. 20% is not zero. The key insight: this isn't new. This is the 12th attempt. But that doesn't mean it will fail. The euro was attempt number 2 and partially succeeded. The dollar itself was attempt number 1, replacing gold, and fully succeeded. So don't dismiss BRICS because of the previous failures. But don't bet the farm on it either. Track. Adjust. Hedge. For the detailed tracking dashboard, join the membership for real-time BRICS currency volume tracking, quarterly indicator updates, portfolio rebalancing alerts, Excel model with automatic allocation calculator. Link in description. Final thought. In 2000, experts said the euro would fail. It didn't, it captured 20% of reserves. In 2010, experts said the yuan would replace the dollar by 2020. It didn't, it's at 2.7%. In 2025, experts are divided on BRICS. Some say it's the dollar killer. Others say it's dead on arrival. The truth, as always, is somewhere in between. Your job isn't to predict with certainty. It's to understand the possibilities and position for them. 50/30/20. Failure partial revolution. Plan for all 3. I'll see you in the quarterly update where we track which scenario is unfolding. Until then, watch the data, not the hype.